Welcome back. You're still tuned into MF Corner. We still have with us R. Srinivasan, the Chief Equity Investment Officer at SBI Mutual Fund. You know, we've spoken about a lot of things. How do you look at picking stocks for a mutual fund, a particular category? Now, in the age of this non-stop news flow across mediums, be it social media, be it the other channels, how do you sift through and find the most promising ideas? What is your process? We would like to know that.
So we have a large team. We have senior sector analysts who've been covering their sectors for a very long time. We run a diligent process. So we have a forensic model, for example, which runs across 650 companies, looks at 18 odd factors. We just finished discussion on the quant score, which basically looks at large caps largely because the data there is clean. And basically the quant score tries to capture the mind of an analyst the way the analyst looks at stocks from a 1 to 3 year perspective. And then we reconcile the differences between what is coming there on the top quintile and what the analyst views there, for example. Whenever there are these new companies that come up for IPOs, we have a very long system of, so we have a checklist, we kind of do our channel checks, we speak to vendors, suppliers, clients, competitors. And essentially, I think at the end of it all, whether it's a new initiation or whether it's a meaningful upgrade, we run a dialectical process where we sit together, discuss our thesis, look at numbers, check out the valuations. I think you just keep doing this. It's not so tough to keep away the noise. You focus on what you think works in investing and keep doing it diligently.
Okay, that is on the process of selecting stocks. Mr. Vasan, what are some pockets that you think that you would like to get into if they do become cheaper? You know, because you have spoken a lot about the fact that some of these stocks are just way too expensive right now. But what are some, well, if you're not willing to tell me stocks, maybe sectors or themes that you feel like you would want to deploy money into when valuations come down a bit?
So consumer staples has been an upgrade after a very long time. I think the research has been, our research team has been underweight consumer staples for like maybe 5-7 years, and they've recently kind of upgraded that. So we're looking at it. And what else? I talked about industrials, manufacturing, for example. If valuation's correct, I think this is a space where we think earnings growth can be meaningful and a lot more sustainable. So that's a space we are looking at. Otherwise, they're all stock-specific names. For example, names we like where there is a... So consumption in general seems to have slowed down, which is like something that we're worried about, at least in some of the names that we're looking at. And if we see kind of earnings picking up there, then we'll, or if these stocks correct, either of the two, we'll be happy to buy in more.
Okay.
So consumer discretionary selectively.
Okay, so consumer discretionary is something that you would look at, and industrials as well if something corrects there. You know, there's a microcap passive fund in the market now. So do you think this makes sense, or is active the way to go when looking at small and microcaps? Because that's been an ongoing debate, but we would like your take on that.
So it compounds that small cap issue, right? Too much money flowing into too few stocks. So I don't know, a passive fund in microcap, how well it will be able to track the index if you have significant flows. But I guess, yeah, it's, I don't know what to say about that. I mean, size is a problem, I guess, in this space, whether it's a small cap space. Micro cap, I presume, is lower than small cap, obviously. So maybe the 500 stock downwards, there's hardly any liquidity there. So the moment you start getting money, how do you deploy it? That is really the bigger challenge in small caps and micro caps.
No, I guess the debate was that, you know, because a lot of these stocks are not so well tracked, do you just want to get into the entire basket, or should you trust a fund manager who knows, you know, what he's doing and to pick out what looks better among the lot? I guess that is the debate. But you think passive is okay in this category? Would SBI look to launch one?
No, you're asking an active manager whether passive is better. In fact, no, conceptually, but where there is a significant... So if you have a higher potential of losing money, then you should obviously be active, I think. So the small cap space, for example, right, you will, if you buy a lot more small caps out there as a basket, the probability that you lose money is higher. So you have to be more selective in a space where the divergence in terms of performance, I'm talking about underlying fundamental performance, can be very significant, where you have a lot of fraudulent managements. For example, India, there are like 5,000 companies listed, 4,000 are like, they vanished without a trace. Even out of those 1,000, take out the large caps, and I'm presuming that 50% will be not worth investing in.
Yeah.
So I'm not sure whether you want to run a passive strategy there.
Yeah, that is exactly the fear that everyone had, you know, when we heard that there was a passive microcap fund being launched.
Yeah, so the volatility will be higher, I guess.
Okay.
I don't have much thoughts on this yet.
Okay. The other space that I want to ask you about is this new high-risk category of mutual funds that SEBI is considering. We do know that they've reached out to the AMCs to sort of, you know, get their thoughts in as well. What do you think? This is a category that's aiming to look at microcaps, junk bonds, but you think this makes sense maybe with an investment, a minimum investment amount?
I think AMFI is looking into it. And SEBI probably wants, so the risk in an organized setup like an institutional framework like ours or people like us, I guess is relatively lower. So I think there is a case for us to launch a PMS type product where you not only own fewer number of stocks, you also let maybe the highest holding to run beyond 10% on a passive basis, or launch a product where you have a total expense ratio which is linked to excess return, for example. So you take a share of the excess return, something like that. Maybe this is the thought behind that. Is there a case for it? I guess there is.
Okay, just one final question now. If someone is looking to sort of create a portfolio right now, long-term investor, say 5-10 years, what would you recommend as a split between the mid, small and large cap? Since we have spoken so much about this, what would you recommend to someone looking to get in right now?
See, this whole capitalization breakup and looking at risk or returns based on market cap is highly overrated, if you ask me. If you come into equities, you should invest from a long-term perspective. Now, if you come in with a long-term perspective, it doesn't matter which market cap bucket you're looking at. What is important is that you're buying a good business run by guys who've delivered over a longish period, and ideally at prices which will make you money. So that's really the way to look at investing, rather than you will end up with a lot more mid and small caps because there are a lot more mid and small caps out there. I wouldn't recommend a capitalization based breakup if you're a long-term investor.
Okay, all right. So we take your point, and I'm sure the viewers did too. Thank you so much, Mr. Srinivasan, for joining us today on this masterclass as to how to look at investing at any level and how do you approach your investing ideas as well. Thanks a lot for tuning in today. And that's all we have on the show today. Stay tuned to CNBC TV 18 for other news and updates.